Hello and welcome to Global Markets, where we discuss trading, investing, and economics twice a week on Thursday and Sunday. Today we start off our brand new series, How to Invest Like Warren Buffett, where we'll be going over the 101s of value investing. We'll be covering what value investing is, how to look for businesses to shortlist, what is an economic moat, how do you analyze a business, and finally, how do we value a business and plan entries and exits. Doing so, we'll be using tried and tested techniques used by Warren Buffett, Cathie Wood, and other value investors who have built their empires. These methods have provided huge rewards for investors and is also relatively safe and reliable compared to highly volatile trades in cryptocurrency, day trading, and swing trading in highly volatile assets. These are investment techniques that have been tried and tested throughout a long period of time. So we hope that you'll join us on our Value Investment 101, How to Invest Like Warren Buffett video series. Hello and welcome to this episode of Global Markets, where we'll be talking about what exactly is value investing. For those who don't know us, we are a YouTube channel who will be talking about trading, investments, and economics each and every week on Thursday and Sunday. We are a growing channel and we'll appreciate it if you can like and subscribe and share this video. So, what is value investing? Value investing is a strategy where we pick stocks that are trading for less than intrinsic or book value. So that is how much an investor thinks that the stock is worth intrinsically. And they think that the stock market is underestimating a fair price. They believe that the stock market has overreacted to a certain event, meaning that we have an opportunity to buy these value stocks at a discounted price that is on sale. Some key terms to understand about value investing. Firstly, value investing concerns market value and intrinsic value. The market value is determined by the price of the share by market forces. So that's how much the share is trading for currently. And this is subject to market bubbles and overreactions by the market. And we often compare this to intrinsic value. Intrinsic value is how much the company is actually worth from earnings and growth rates. This is a measure from statistics and analysis rather than public sentiment. We can calculate the intrinsic value of a share many different ways, and generally we'll be using fundamental analysis techniques. And the guiding principle for value investors is the notion that the market value will always meet the intrinsic value eventually. So what we are looking for as a value investor is we are looking for when the market value is at a discount to the intrinsic value. This lets us jump onto a share that we believe is worth more than the market says it's worth, and we can ride that share to potential profits. So value investing is often compared to passive investing, as they are different share investing styles. Value investing is one, and then the other common one is passive investing. So value investing is, as we have said before, when we are looking for specific shares where the intrinsic value is more than their market value. Whereas passive investing will be when we just dump money on a periodic basis using a term called dollar cost averaging. And we invest in market ETFs and we expect to get the average returns of the stock market over a period of time. So if we compare some pros and cons of them, we have a few things to know. If you intend to be a value investor, you must be active to an extent in your investments. Whereas if you want to be a passive investor, you can, for the most part, set a cycle of investments and forget about it. Value investing does mean you have less asset exposure, and this can be an increased risk to your portfolio if not done correctly. Whereas passive investing, we have extreme diversification, which can help limit risk. However, if value investing is done correctly, the returns can greatly outperform the index by a very large margin, potentially 5 times, even in some cases 10 times. Whereas passive investing, your returns can be limited as you're going into a market, ETFs, opposed to individual shares. With greater diversification, there comes less risk, but also less reward. So should we be focusing on market diversification? If we go to who this course is outlined after, Warren Buffett, he says, diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. So to clarify, Warren Buffett, he's not saying that diversification is bad. He's saying that if you don't want to be actively involved in the market, then you should diversify because it will mean that your falls will be less. However, he also does say that if you have good share ideas and if you're tracking the market, your investments will be returning much more money. So there are a couple of notes of philosophy that we look at when value investing. Firstly, we tend not to want to diversify our capital and waste capital. Instead, we want to invest in our best ideas and ride them out for their future returns. Warren Buffett says, why would you waste your money on your 20th best idea opposed to your best idea? And that is the philosophy of value investing. Furthermore, value investors are in it for the long journey. So we're not looking to swing trade or day trade stocks. We're looking to hold these shares for a long time until we think that the market has met the intrinsic value. And value investing always falls down to market value versus intrinsic value. We want the market value to meet the intrinsic value, and that's where we sell. And when we believe it is at a good enough discount, that is where we buy. So what are the stages of value investing? In this video series, we'll be going over the stages of value investing. Each stage will have its own video, which we'll be releasing every Thursday and Sunday. So firstly, we'll be creating a business shortlist. We'll be looking at promising sectors, how to determine based on news what sectors and industries are going to be performing well, and how to create a shortlist of businesses with good growth potential, as well as some reliability. Secondly, we'll be looking at evaluating an MOAT and looking more into what the business does and how we can be sure that they cannot be copied and how we can be sure that they are a safe investment. Then on our third episode, we'll be looking at the reports and the people who run these businesses. We'll be looking at the figures and the people to determine whether there are any fundamental issues or benefits with the company. Then we'll go on to valuations, margins of safety, and entries. We'll be looking at how to value a share, how to make sure that we are buying at a margin of safety, to make sure that we are not exposing ourselves to excessive risk. We'll be making sure how to time our entries perfectly. And then on our final episode, we'll be looking at risk management techniques, including stop losses, exits, and even put options to cover your share potential losses. So as said previously, that is all for this video, and we'll be releasing the future episodes in the series every Thursday and Sunday. Be sure to like and subscribe to get future news on trading, economics, and investments, as well as the next coming videos in this series. It would greatly appreciate anyone who subscribes, as it will greatly help us grow our channel, as we are a small channel just starting out. Thank you for watching our video, and we hope that you can learn and take these principles and apply them to your own investing.